the uses of swaps is what I want to talk about, and I want to give you the first part of this. Now let's take, for example, we've got a bank. And a bank tends to have investments like assets or loans. Let's say they've given out a loan. This is a real-life case study from the 1980s, where interest rates were really high. And so banks were handing out loans at 12.5% to their clients. So the loan pays the bank 12.5%. Where does the bank get the money from to fund this? The bank takes in a deposit. Now, on our deposits, we do not receive a fixed rate, we receive a variable rate, which is based on some index, such as LIBOR. But of course, we don't earn LIBOR as retail customers. It's more like LIBOR minus 300 basis points, which is close to zero at the moment, or even negative in some cases. Now, when LIBOR was at 8%, that meant the bank was paying out 5, they were receiving 12.5%, and they were making 750 basis points or 7.5% profit out of this. So this was the old school of banking, which we call the 9-6-3 rule of banking, which is you lend out at 9, you borrow at 6, and you play golf by 3. Now, here, of course, there is a underlying risk, and the risk is that LIBOR could rise over 12.5%. In fact, at 15.5%, plus the 300 basis points, that's when the banks would go under. Now, you would argue with LIBOR being at 8%, that would never happen, but the reality was that 2,500 banks in the United States went bust because they ran their balance sheet like this. It was called the savings and loans crisis in the mid-1980s. Now, there is a very simple way on how you could hedge this. You could engage into an interest rate swap, whereby the bank would be paying to a third party a fixed rate in return for receiving LIBOR. So, of course, this will be now a question of how high is that fixed rate. But let's assume the bank would be willing to pay 12.5%. Then they would have locked in their 300 basis point and potentially a margin on the loan side as well, taking away the interest rate risk that they would have from LIBOR moving up and down. To do this, of course, they would have to engage a third party here, which we will call a market maker. The question now will be, and that's what you will learn on the course, is what happens to the market maker? How far will they pass on the buck, and who will stand in the end to manage that risk?